Welcome back to another episode of Talking Shit. Shit, of course, is an acronym for Straight Health Insurance Talk. My name is Matt Allen, and with me is Aaron Miller.
How we doing?
Fantastic today. We have a very spicy topic. We're going to be talking about COBRA COBRA in regards to health insurance, not the snake, I believe.
And when I first started in health insurance, I was like, COBRA. They named it COBRA?
Yeah.
I mean,
Cobra Kai.
it's a good snake.
Yeah. One of the best.
I mean, it eats other snakes, doesn't it?
I have no idea.
I think it does.
Wow.
Yeah.
Okay. There's a lot of misconceptions about COBRA. There's a lot of intricacies about it. But if you zoom out far enough, it's a pretty straightforward process for the majority of people. So what do you got?
Well, I think the biggest thing is people, are in transition, right? They have gotten health insurance through their job, and this transition typically includes a COBRA letter. So I guess let's start from the top. What is COBRA at its core?
COBRA at its core is the Consolidated Omnibus Reconciliation Act.
Sounds right.
Is that right? Okay. It's of 1985. Basically, the reason COBRA came out was back before 85. If you had a small group plan and somebody got sick, you could just fire them, and then they lose their health insurance. You could just say, hey, Mary, I know you got stage 4 cancer. It's really driving up our health insurance premiums. We're going to kick you off. And there was no real recourse. Now, this wasn't some sort of very common thing to be happening. People aren't animals, but it did happen often enough, and there was just, frictional unemployment. And basically the COBRA Act, it was designed to protect employees from being mistreated by their employers in regards to health insurance. So essentially, if you voluntarily leave your job, or if you are let go, laid off, fired in disgrace, whatever, you can keep your health insurance through your job for up to 18 months after that, including if your spouse is on it or your kids or the whole family. There are certain carve-outs where a small business, with fewer than 20 employees doesn't have to offer COBRA. But for the overwhelming majority of people, they will be offered COBRA, and they can keep that for 18 months. Now, a common misconception is that COBRA is really expensive. That's not the misconception, but people are thinking that it's like a different plan. Like, oh, you're going to go on COBRA. Well, you do go on COBRA, but it's just a continuation of your current benefits. And the reason that it's so expensive is you are not only contributing your employee portion, but you now have to contribute the employer's portion as well. And they tack on typically a 2% administrative fee, which drives the cost up. And I think a lot of employees are just shocked. They get sticker shock at the COBRA letter because they don't actually realize how much their employer is kicking into their health insurance premiums, which is usually pretty substantial.
Yeah, I mean, for some insight, we see COBRA prices come in because people are leaving jobs, people are retiring, and if that is the case, we're often comparing COBRA to the options on the individual marketplace. And so people have come in. I mean, what are some of the highest COBRA just premiums that you've heard of? I mean, I've heard $2,000-$3,000 sometimes.
Well, it's going to depend if you're an individual or you're individual and spouse, or
Sure.
if it's a family. That's really what it comes down to. But it's not uncommon for us to see a family be over $3,000, or a husband and wife be at $2,000, an individual up to $1,000. But then you get these weird cases. I've got one right now where a husband and wife, it's $1,200 for COBRA. How can I tell them not to take that? Because the alternatives are going to be more expensive, unfortunately. They are going to make good money in retirement. Not going to qualify for any tax credits on the marketplace. So in some situations, the COBRA premium is somewhat, quote unquote, reasonable, even though $1,200 does seem still kind of like a lot, in an absolute value, but relatively with health insurance, that's kind of a bargain for people in their 60s. So it varies in range, and it's really going to come down to where you are at geographically, what the overall cost is to insure your group. So a younger, healthier group, they're going to have cheaper COBRA rates. because the overall premium is going to be lower. So there's so many factors that are into it. But a quick way to sort of reverse engineer what your COBRA would cost if you were to leave your job is to look on your pay stubs and see what you are contributing to healthcare. So employee contribution to health insurance and then employer contribution to health insurance. Just add those two together, tack on 2%, and that's your COBRA cost.
So when you say continuation of care of coverage, so like if it's the middle of the year, does their deductible stay where it's at? Does their out-of-pocket max stay where it's at? Like it just carries on for as long as they continue that COBRA coverage. Nothing resets when they decide to go on.
No, it doesn't reset only at the annual enrollment period. So there are some small groups that have an enrollment period in March or in October, and so that's when it resets. But the actual act of going on COBRA doesn't reset anything.
Nice.
Yeah.
And so when someone decides to continue their coverage with COBRA, when does it start? What sort of timelines do they have to work within to either choose COBRA or find an alternative?
Well, COBRA picks up right when your group insurance leaves off. So let's say your last day of work is going to be March 31st. Well, COBRA would start April 1st, and it'd still be the same exact plan. And then you would have 18 months from that day that you could keep COBRA at the full price. And so that would run you until, September of the following year. And at that time, you would also have something called a special enrollment period. So let's back up for a second. When you leave your job and you get offered COBRA, that is considered a qualifying life event. And what that creates is something called a special enrollment period. All of that is to say you don't have to take COBRA. And even if it's in the middle of the year, like let's keep running with the March 31st example, your open enrollment period, your special enrollment period, it starts April 1st and it'll last all the way to June 1st. So you can hop onto a new plan April 1st, May 1st, or June 1st if you're looking outside of COBRA. Specifically, you asked, though, what are the enrollment windows for COBRA? Well, you technically have a 60-day grace period in order to enact COBRA and come back and say that you actually want it. Because what we've found is most of the plan administrators and HR departments, they kind of drag their feet on getting that COBRA paperwork out. So if you were to leave your job March 31st, you might not see your COBRA paperwork with your COBRA offer letter until the middle of April, the end of April. It's kind of crazy. But you do have 60 days to then retroactively go back and say, hey, yeah, I did want COBRA.
Yeah. So I was actually talking to a guy who is changing jobs, and there was going to be, a potential 2-week, lapse in coverage in his mind, because he's like, oh, I'm starting the next job in 2 weeks. This coverage ends at the end of the month. What do I do for this 2 weeks? And I'm like, well, good news. You actually don't have to do anything because you are able to retroactively, invoke COBRA if something does happen where you need it, right? So is that sort of the strategy if someone's just changing jobs or is, 2 weeks away from turning 65?
We definitely always recommend to look into as many options as you can when it comes to COBRA. So to sort of explain more so with the actual example with dates, let's pretend you get laid off. Your last day of work is going to be March 31st. And you're not sure if you're going to have a new job lined up very quickly. But let's pretend you get a new offer and you're going to have benefits that start June 1st. So between April and May, you don't have any coverage. But the new job's going to get you coverage June 1st. So what do? A lot of people would say, well, I'll just take out COBRA for those 2 months. And let's pretend your COBRA was $2,000 a month. Well, in all likelihood, depending on what's going on health-wise with your family, if you haven't hit your deductible yet, if there's no procedures coming up, if a baby's not being born, if we don't have $1,000 medication, essentially what I'm saying, if for the months of April and May, you don't have some ongoing medical costs coming up, why are you spending the $4,000 on the COBRA? Now, I'm not saying to just simply go without health insurance, but I'm saying why don't you just float the COBRA to get you to June 1st? And if something comes up in April, if something comes up in May where somebody in the household needs medical care and we have a surgery or have an accident or we have an expensive medication, well, then you can go back to COBRA and you can say, hey, actually, you know what? I did want COBRA for April and I did want COBRA for May. You'd have to retroactively go back and pay that $2,000 for April and $2,000 for May. But if it's all smooth sailing with the family through April and you get all the way through May, and then the new job starts June 1st and the new coverage starts June 1st, you've now saved $4,000. You don't have to invoke the COBRA. You don't have to say you need it because you have that 60-day grace period. So that's typically what we recommend. Now, if you can do the same thing when you're 64 and 10 months old to get you to 65, that's great. Most 64-year-olds have some sort of health stuff going on. But if you can make it that far, great. If you can make it that in between jobs, if you can make it that in between a kid starting college and needing to go on to university health insurance, like if there's that 60-day window between old coverage and new coverage where nothing goes on health-wise, you can typically save a couple months of COBRA.
That's great. And people don't realize about being able to retroactively invoke it. So I think that could help a lot of people. The other thing that I find interesting is even if you do say, yes, I do want COBRA, I'm going to start this period where I'm using it, do you have to keep it for the full 18 months?
No.
People think that it's, I'm locked in.
You are not locked in. You can cancel it at any time. But here's the rub. If you want something other than COBRA, and let's pretend that that's a marketplace plan, so through the Affordable Care Act. Let's say you're working a job and they unceremoniously lay you off. They lay you off March 31st. We're just going to keep going with the March 31st example. And let's say you're kind of looking for another corporate job, but you really want to start that business. You want to start a new business. You want to be self-employed. You want to go into business for your own. Okay. But you don't figure that out until, let's say, July. Okay? So that's outside of that, free 2-month float that you get with COBRA. And let's say you still haven't had health insurance lined up yet. Well, if you go back and you elect COBRA for April and May and June, you start your new business in July, you're kind of stuck because you're outside now of your 60-day special enrollment period due to the qualifying life event. And at that point, you can no longer get a marketplace plan in the middle of the year because you took COBRA out for 90 days and it exceeded your special enrollment period. You don't have that enrollment period anymore. We're now in the middle of the year. So you would essentially, if you wanted to keep health insurance, have to ride COBRA out through the end of the year. Now, you can still cancel it at any time, but your voluntary ending of COBRA, you simply saying to COBRA, hey, I don't want this anymore, that in and of itself is not a qualifying life event. That does not create a special enrollment period, and you cannot then go on to a marketplace plan anytime you want. In that particular situation, that person would probably have to pay COBRA through the end of the year and then hop on to a marketplace plan during the open enrollment period. Does that make sense?
Makes sense to me. So essentially at the beginning, when you're offered COBRA, you get this period where you have kind of the full list of options to enroll in. You have the marketplace, you have COBRA, you have private underwritten plans, everything available. And then after that 60-day window, if you're still on COBRA, you lose that ACA Marketplace option.
That's a great way to explain it. And that's exactly correct. So it's always best to examine your options sooner than later. Don't feel like you are tied into COBRA, though. You had mentioned these private medically underwritten plans. Those are still a really good alternative, especially for self-employed people and especially for healthy people. And those ones, you can sign up any time of the year. So in that example, if we go back to the guy who got laid off March 31st, he took out COBRA, paid it for April, paid it for May, paid it for June, said, you know what, I'm just going to start that business. I'm going to be self-employed, opens the doors July 1st. At that time, in the middle of the year, you can still apply for a private, medically underwritten health insurance plan. Those plans have a 365-day a year open enrollment period. The 60-day window following his loss of work and loss of work coverage only applies if he wants to go on a Marketplace plan. So he can take out COBRA for 90 days if he wants. He can then apply for a private medically underwritten plan to start July 1st, which is a great option for lots of entrepreneurs anyway. That is a way that you could take out COBRA and terminate it early because you don't need the special enrollment period to go on to the private plans.
Got it. So I think another interesting scenario is when we talk about early retirees.
Mm-hmm.
So we have people who, let's say they're in between 62 to 64, maybe they're 63 and a half, right? Because we want to think about COBRA in terms of taking it all the way to 65. When would you recommend someone keep COBRA through the term until they reach Medicare age?
Every time.
Every time.
As long as it's affordable. If you're 63 and a half or older and you're offered COBRA and it fits into your retirement budget, just take COBRA. Why are you even shopping around? It's a plan you know. It's a plan your providers know. You know what to expect with it. Just pay the premium, and then once you hit 65, you'll be on Medicare. Things will get a lot cheaper, easier, better, faster, quicker, stronger, all the good stuff. But if you can afford COBRA and it can take you all the way to 65, absolutely. Take it 100 times out of 100 times. Now, if you can't afford it, maybe you shouldn't be retiring early. But if you can't afford it, then we can look at alternatives. But if it fits into your retirement plan, please, just take COBRA. Make it simple.
No, I like that. And I feel like a lot of early retirees get some comfort in that as well. It's like, well, if it's in my financial plan, I can just keep it and, smooth sailing.
Yeah, but sometimes we run into a couple who, aren't precisely the same age. And so the spouse who is carrying the insurance may be 63 and a half and may say, hey, I want to retire. COBRA can take me all the way to 65. But what if their spouse, who is also on the health insurance, is only 62? What do you do then? Well, then I'm going to want to take a look at the whole health profile of the family, the projected income of the family. What does COBRA cost? Are we doing some traveling? Are we going to relocate in retirement? There's so many factors that then come into play, because if I just tell them blanket statement of, hey, just take out COBRA for 18 months, it'll get one of the spouses to Medicare, and that's great. But we're kind of just kicking the can down the road for the other spouse, because the other spouse, the 18 months will get him to 63 and a half. Then what are they going to do for the next 18 months? So in some situations like that, it will make sense to move the couple off COBRA right on retirement if we can get income in the right ranges to get tax credits through the Affordable Care Act, yada, yada, yada. There's so many different nuances there. But if it's just one person or both people are within the range that COBRA can take them all the way to Medicare, just take COBRA.
And then there's also the question of, okay, we did take COBRA, right? Me and my spouse, let's say I was 60, they were 64, now they're getting on Medicare. Should I keep COBRA, or does them getting on Medicare create another special enrollment period? What happens, during those transitions? What happens when COBRA ends? There's a couple of different things in there where people want to know, when do I have the full range of options?
So you'll have the full range of options at COBRA's natural expiration. So if you take COBRA all the way to 18 months, when it expires, that's going to be another qualifying life event. That will create another special enrollment period. We can hop onto the Marketplace or a non-Marketplace plan at that time. In your example of somebody being 64 and 60, let's say the 64-year-old graduates to Medicare after only 12 months of COBRA. Well, the other person, they can change at that time when the person graduates to Medicare, or they can continue the COBRA at a reduced rate for the next 6 months, and then they've got another qualifying life event. So there's a lot of moving parts here with COBRA. But in those scenarios, that's what would happen.
Got it. I also think it's interesting. People always ask, can I keep my dental and vision through COBRA? Or does it all kind of have to be lumped in together?
So the dental and vision is going to be separate from the health. And what we've honestly found is we can save a lot of people a lot of money by not electing COBRA. But we can almost never save people money on their dental and vision through COBRA. It's usually a really high quality plan at a really low cost. So we have many situations where we're going to recommend, hey, you retired at 59 and 58. Let's get you over to the Marketplace. Let's get you a good supplement because you're going to want to travel. But man, I can't beat that dental and vision rate. Go ahead and take that dental and vision out for those 18 months.
And you really don't need any special enrollment periods for dental and vision. There might be some benefit to be on a plan for multiple years, like the benefits may grow as you're on the plan, but I mean, there's no need for any specific special enrollment period with dental and vision.
No, on the individual market, there's no special enrollment period needed for dental and vision.
Got it. I think the only other questions that I've found when searching the retirement forums and COBRA forums is talking about HSA, and can they use their HSA to pay COBRA premiums?
Absolutely, you can. That is one of the qualified medical expenses for HSA funds to be used is your COBRA premiums. You normally cannot pay health insurance premiums with it, but you can use those funds to pay for COBRA premiums.
Very nice.
It is nice because a lot of people love that HSA and they want to use the dollars, and it's kind of hard to use the dollars once you're on Medicare because you just don't have that many qualified medical expenses.
What other things come to mind when you think COBRA that people need to know? I mean, especially with potentially all these AI taking people's jobs, a lot of people might be facing COBRA.
I think as we move into an economy with more self-employed people, more gig work, more unfortunate AI layoffs, I think you're going to see millions of Americans faced with COBRA decisions. And they need to be informed on what the alternatives are, what the benefits to COBRA are, what the drawbacks are, and what information that they need to know about the alternatives. Because if we're looking at a marketplace plan or a non-marketplace plan as an alternative to COBRA, should really sit down with somebody who knows what they're talking about. Because unfortunately, what a lot of these people have never done who are going to get laid off is shop for health insurance.
Right.
They've always gotten it through their job. And so when they go out into the open market to find, a substitute for that, oftentimes they're going to make mistakes, and it's not really necessarily their fault, but you can always consult an expert who can help you with that.
Absolutely. No, I feel like COBRA is one of those things that people get sticker shock and they get a little freaked out. And so, I overhear your conversations, and people, once they understand the alternatives, COBRA's not so scary. And as long as they're not 63 and a half or older, they have good options otherwise. Yeah.
And I do want to clarify something now that you brought up the 63 and a half and older. There are some couples who maybe the person carrying the health insurance is 67 and they just had to work longer before they could retire. No big deal. And they're 67, but their spouse is 62. When that person who's 67 retires, we're going to always recommend they go on Medicare. You don't want to take out COBRA for both of you. But their younger spouse can take out COBRA on just him or herself.
Okay.
And the one who is carrying the insurance can go on to Medicare. So that is something that a lot of people don't realize. Now, whether or not at 62 COBRA is the right fit, that's really going to come down to a situational thing. But that's absolutely something that's allowed.
Very nice.
And the very last thing that I want to say about COBRA is actually situational. So we deal with a lot of early retirees, a lot of people who they've been, prudent with their money and their investments, and they've saved up and they're ready to just cut the cord. They want to retire. They want to visit the grandkids. They want to go down to Florida. They want to learn to sail. I don't care what it is, but they've earned the right to retire. Sometimes, even if COBRA won't get you all the way to 65, let's say you're both 60 years old, sometimes I'm still going to recommend you take COBRA for the full 18 months, even though we're kicking the can down the road of having to make a new health insurance decision. Even if it can't get you all the way to 65, I'm going to recommend it in a few situations because sometimes COBRA is the same price as the alternatives, and that may seem crazy, but let me unpack that a little bit. a lot of our early retirees, they go to the ACA Marketplace because the two things that are great about the ACA Marketplace is that it covers pre-existing conditions right away, day one, no questions asked. And the other great thing about it is if your income falls within a certain range, you can receive a tax credit to help lower your premium costs. And so what a lot of early retirees do is they've got some kind of health condition going on that they want coverage for right away, and their income drops precipitously from when they were working. Maybe they're not taking Social Security yet. Maybe they're not drawing a whole bunch of distributions. Pensions, they're kind of a thing of the past. So in retirement, they may be showing a very low income. And so when they leave their job, we're going to want to go to the ACA, get their pre-existing conditions covered, take advantage of the tax credit, maybe add a supplement on there because they're traveling all over the place. And that's a really good plan. But there are some early retirees who are 60 and 60, and they just cannot get their income low enough. They say, Matt, I saved all this money to enjoy my retirement. I'm taking distributions. I'm going to draw Social Security early. I do have a pension. I've got rental property income, whatever it is. If your income in retirement is higher than the threshold to receive a tax credit on the Affordable Care Act, and we are comparing COBRA straight to an ACA Marketplace premium, they're going to be about the same. A full-priced ACA plan is very expensive. And so if it's between your COBRA or an ACA plan and they're about the same cost, I'm going to recommend you just stick with COBRA. Stick with the plan that you know. Stick with the one you're comfortable with. And it's typically going to be a higher quality plan than the ACA Marketplace plan. And then after the 18 months are up, you can always hop onto that ACA Marketplace plan. It'll always be available because the expiration of your 18-month term from COBRA creates the ability to hop onto the ACA Marketplace. And so if you have a pre-existing condition and your income is above the threshold to get an ACA tax credit, even if COBRA won't get you all the way to 65, I'm probably going to recommend you exhaust it because if it's the same price to go onto an ACA, it's going to be lower quality. Let's just take advantage of the COBRA while we got it.
Yeah. No, that makes sense to me.
Now, the alternative there, let me keep pulling the thread. What if you're healthy? What if you're healthy and you can't get your income below the threshold? Well, then there's an alternative option for early retirees, which is actually my favorite option.
Tell me.
Let's say you're both 60. Let's say you're both in good health, but you're drawing, you're going to earn $120,000 a year in retirement. Well, COBRA's not going to get you all the way to 65. What you can do instead is you can take out a private, individually, medically underwritten health insurance plan that has no network restrictions, that'll probably be pretty similarly priced to COBRA, maybe a little cheaper. But what this plan allows you to do is you can keep this plan all the way to 65. This plan is not a year-over-year renewal. It's not a short term. It's not only 18 months. It can take you that full 5 years, have no network restrictions, like a $5,000 deductible, and you can have cost certainty on that because you're not going to, we've already established your income's too high to get a tax credit on the ACA.
Right.
So it's either full-priced ACA, private plan I can keep all the way to 65, or COBRA for 18 months. If all of those are similarly priced, I'm going to say take the private plan. Lock in that plan for those 5 years, because if you end up taking COBRA for 18 months and you go, hey, it's about the same price as the private plan. We're healthy, but we know this COBRA plan. We know it. We want it. We're going to take this out. Here's the nightmare scenario that can happen. What if you develop a condition while you're on COBRA for those 18 months? That COBRA is only going to get you to 61.5. If you develop a health condition while you're on COBRA, now that private plan is not going to be available to you because you won't qualify for it medically. Now you're going to be relegated to an ACA Marketplace plan, and those are lower quality and same cost as your COBRA. So if people are retiring, they don't get a tax credit, and they're healthy enough to qualify for a non-marketplace underwritten plan, I'm going to recommend that one.
That makes sense. Get in while you can.
Get in while you can, keep it all the way to 65, then cancel the whole thing, Get on a nice Medicare supplement, costs go down, benefits go up, gets a lot simpler.
Yeah. Then you're not subject to the price hikes on the ACA. You're not subject to, that variance of the plans changing year over year.
Exactly. It's benefits that you can count on. These private, individually underwritten, plans, the benefits don't change as long as you keep renewing them. And that's something that you can count on.
And you're going to have to make a change anyways.
Exactly.
Might as well do it now. No time like the present.
Mm-hmm. Got any other COBRA questions?
No. I mean, just that they named it COBRA is ridiculous.
We didn't name it that. It stands for stuff.
Yeah, but what does omnibus mean?
Well, that's the real mystery.
Yeah, no kidding. But no, that's what we got today. COBRA explained. This has been another episode of Talking Shit, straight health insurance talk. Thanks for tuning in.
Thank you.